Good morning and good afternoon, and welcome to The Point. David Balin and Stephen Whiting, both in different parts of New York, bringing you our weekly broadcast, which this week is entitled Innovation and Dysfunction Equals Diversification. The diversification part is what you should do when we come to the end of this broadcast. But in the meantime, we've seen some wild action in markets, especially in technology, in gold and silver, and we're going to try to explain this. But the choice of Fed Chair Warsh, which we're going to talk a lot about, is very important. It actually moved markets extraordinarily, and I'm going to interview Stephen a little bit about Warsh's background so that you can understand why markets did that. The House Democrats, delayed passage of a bill to fund the government, and basically they came to an agreement to briefly fund the government dealing with the issue of ICE and ICE's funding, which has been delayed for 2 more weeks. But as Stephen will tell you, we've already had a second shutdown. It was very brief. You may not have noticed it, but it will have the impact of actually, affecting the data that we actually receive. Gold, as you probably saw last week, went up like a rocket. It fell 13% over a couple of days. It's now bounced back. Silver was up and down, and now it's down again. But what's going on in the precious markets, right, is kind of like what happened in the meme stock moment. And we have to talk a little bit about that because, of course, we have gold in our portfolio as a hedge, and it's not acting that way right now. And Stephen, can you talk a little bit about your corporate earnings news? What's going on right now? We just had Google report yesterday. We have Amazon reporting tonight. Interesting, right? Given what's happening in the market, the software stocks, the AI stocks, the report last night is really extraordinary.
Well, in the case of Alphabet, Google, 24% EPS growth, despite large increases in capital investment. Again, these firms are going to do this, if not just to profit, but to beat their competitors, to stay in this business. It's a lot of competition. There's a lot of cash from private markets funding companies that are competing with these big public companies, and that's going to be these issues. But what we're going to do when we talk about software later in our presentation is just remember that DeepSeek moment. Again, the better use of microprocessors. The point that we had in late January, February of last year when people said, well, we're not going to need these chips anymore because we can use them better, so there will be no demand. In essence, making chips better will mean more demand. This is really something that we should be thinking about in abundance. There's a panic going on in literally the best performing long-term industry. And we're not telling you that some software companies are not going to become obsolete from this. We are talking about competition from companies. But these are things, again, that should not make us panic. What you have to have is the right allocation going into this. Now, in terms of the other things going on in earnings, we're seeing numbers 79% are beating estimates. And, people were saying, well, of course, everybody beats. And that really is true because of the games that analysts really play to make sure that they flatter their companies. But something else happens in the fourth quarter that I hear very few people talk about. The fourth quarter is the one in which companies tend to dump their bad news. Whatever problems they've had beneath the surface, they try to get that out into their calendar fourth quarter to make their year ahead look good. So those earnings beats, I've been listening to people on CNBC say, well, the beats are just not as great as the third quarter. Well, that happens. And we're in a situation where we have a lot of earnings growth. Half of it's being driven by tech. It's a concern to think that we could have so much driven by tech that there's a real boom. Booms are concerns. But this is not an environment of falling earnings, and we'll get to those someday.
That's exactly right, but not today. So if we can move ahead a slide, but I want to talk a little bit about the appointment, right, of Warsh, right, which when you consider all of the different choices that the president could have made, right, and there were some pretty random and irregular, inexperienced choices that could have been made. But markets really reacted to this guy's choice, right? And so I'd like to give a little bit of history, right, especially about what Warsh did, when he was involved, right, directly involved as a Fed governor, and why his announcement was, so impactful to markets and what people expected.
Well, Kevin Warsh is an experienced Fed governor. He resigned in 2011. He's experienced across multiple presidents in terms of serving on economic policy. He has strong views, or at least historically has had strong views about the importance of price stability and the singular focus of monetary policy on maintaining price stability. And so what he did is disagree with the extent of the quantitative easing that we saw during the global financial crisis. Now that you can see is your first arrow on the left, the period around 2008, 2009, you can see that there was a massive rise in the Fed's balance sheet. But you might also remember we didn't have a great inflation in years like 2010, 2011. We ended up in a period till roughly around 2017 with very low inflation rates, slightly below the Fed's target. So how could all of this money printing have not resulted in inflation? It's simply because money printing and money spending are different things. What the government did is use money printing to take assets from one hand and put those assets in another. It wasn't spending on goods and services. And so you can see 17% growth of government spending in a period when the unemployment rate reached 10% and stayed there for a while. That's not anything like the dramatic effect of QE combined with fiscal expansion that we saw around the pandemic. This 2020 to 22 period, hey, government spending growth of 47%. And it wasn't moving assets from one hand to the other, it was sending checks to people to spend in an economy which had major impairments in its ability to produce and get goods and services in the right places. So money printing, money spending, you need both of those things to create inflation. And so Warsh's concerns about the size of the Fed's balance sheet, this is something that markets are going to worry about, that he apparently does believe that interest rates should be lower if the Federal Reserve were getting out of the picture. Now that's something, again, that the Federal Reserve staff and the whole institution of the Fed, the presidents, all of them are going to actually show a lot of evidence on. And the idea that we're going back to the balance sheet of 2007, $900 billion, it's very different in the new financial system that we have. So I think there's going to be probably a lot of speculation about Warsh. The reality is that monetary policy, I don't think depends as much on one individual as we see here. But this particular episode makes everybody worry that maybe Warsh won't be there to fight a future crisis.
Right.
So David, do you want to just talk a little bit on the next page?
Yeah, sure.
It's so hard, again, we can never put our pictures perfectly up to date.
But what's important?
But what you can see here, these little effects here of a little bit of a rise in Treasury bill rates and some steepening of the curve, which is very strange. The dollar, which had been on this easing mode, we had views that President Trump was going to pick someone who was going to just say, hey, whatever you think, more QE, zero rates, whatever you want. And then suddenly he picks Warsh, and he picks this guy who was an historic hawk, and you see the dollar banks bounce back a little bit. Well, if you really want to see the impact, it's the next page, and that's gold and silver, where suddenly you fall 13% and 33% over the course of 3 days. Now, why would that be? Well, take a look at these charts, parabolic charts, where everyone is using gold and silver to express their fear about debasement of the currency, uncertainty about the United States, which is important. It's not just going to be about monetary policy, we just showed you that, but it's this idea that, hey, this is the one thing that we can have, the secret ingredient, and we're going to get rich quick buying it.
So it seems to me that what Warsh did was, in fact, make people reconsider the idea, right, that the U.S. was simply going to lose it, right, that it was going to lose its status, and become a place where people just have to leave because of all of the policy uncertainty. And I do think that legitimately, right, having someone with his experience and background is far better than someone who's never served, right, on the Fed before. And so I think it's important to people realize that this choice, right, no matter what you think of how and why the president made it, this choice of an experienced leader for the Fed ultimately is a better outcome than certainly many others. Let's go to the next slide. And when we take a look at this is very funny, Stephen. I love it. So
okay, we'll
Monty Python, you have to love Monty Python and appreciate the humor of this, because the bunny wasn't as scary. That bunny is Warsh, and they were running away from the bunny. Anyway,
exactly.
Very funny. All right,
exactly.
Next slide. That's very funny. Okay. So what was going on in the US markets, right, is that we saw gold and silver, right, move from a diversified asset, right, to a speculative asset to a bubble asset in the last, couple of weeks. And that was all due to a real issue, right, which is that people were losing faith in the ability for the US, right, to maintain, the kind of status, right, associated with a reserve currency and associated with the idea that it was safe to keep money in the US. Once the dollar starts going down, any non-US investor who actually owns a US asset, right, actually suffers a real loss in their currency associated with the investment they've made in the United States, which is the mirror image of what we had in our own portfolios at CIO Group last year, where all of our assets that were outside of the United States appreciated because of the devaluation of the dollar. Now, if you're the world's largest market and you have the world's largest deficit, you need to have funding associated with people willing to invest in our markets and in our treasury bonds. And so what we saw as a predecessor to the events of the last couple of weeks was that gold and silver, but gold in particular, was rising disproportionately to its status as a hedge. And we believe that loss of trust in U.S. institutions is the largest and best explanation of that. So let's move.
So David, let's stay on these pages for a second. And when you take a look at that left picture, gold is rising against every currency. If you live in a Bitcoin world, gold is rising much faster right there. And you could take a look at the far left, the surge that we had from that period in the 1970s. Now you can take a look at the right. Look at that left arrow going up. Basically some lulls, but more than a decade of accelerating inflation. Monetary policy, completely irresponsible. Money growth exceeds 10% compounded for the entire decade. We get to ever higher highs in the inflation rate. And then it takes Paul Volcker to put an end to this, to restore the US dollar to what it was right after World War II, which is the most trusted currency in the world. Now, if you think about we're having a gold and silver rally that looks like that, take a look at the inflation rate now. There is definitely a slip around the pandemic. People have experienced a higher price level. That's very difficult for them, but it's not that same picture. Now, if you look at the next page, so if this isn't just monetary policy that's causing, again, these concerns about the dollar, what is? Well, you take a look at the right picture. There's the Categorical Economic Policy Uncertainty Index. So this includes trade policy. Suddenly, we have potential tariffs on Canada, South Korea, the United Kingdom. Whenever the president wants, he's going to unilaterally say, I don't like what you're doing, I'm going to tariff you. And there are other aspects. Security policy is wrapped up in this picture on the right. Look how different this picture looks. Now, if you look at the picture on the left, that shows U.S. Treasuries, their custody holdings. Now, these are official holdings. We don't have all the details on that quite as much. But foreign central bank holdings of U.S. Treasuries held in custody by the Federal Reserve as a share of the whole U.S. Treasury market. It's been coming down for a decade. Back in 2018, Russia eliminated its U.S. Treasuries as foreign reserves. China, it's come down 46%, at least in terms of the whole country over the last decade. But what about individual American citizens, about citizens throughout the whole world who suddenly don't feel so secure that the United States is always going to be on their side? Or about countries, whether or not allies are treated the way they have in the past. They suddenly become less convinced that the U.S. should be the entirety of their foreign reserves. And that's a reason, again, that we're seeing some downward pressure in the currency, some rise in risk premium. We showed you previous weeks how U.S. yields are moving up relative to Swiss franc yields. This is the kind of thing that is more than just Kevin Warsh.
That's exactly right. All right. And one of the reasons why, by the way, for U.S. investors, we've increased our exposure to international securities. But at the end of the day, it's a policy issue, right? And so we're going to see a little bit of data that's missing once again, Stephen, in terms of labor force information, right? But what I love about this chart, right, is how people report themselves, right? How people report on themselves, right, actually does matter.
Well, we would have an employment report tomorrow. The government shutdown is over. but government data has been delayed again. And so this is, again, a question is like, what kind of place is this? How do we run this place? The government is shutting down every 3 months. I just pointed out here, again, some of the things that we want to look at. The labor force has been growing. Fed Chairman Powell wants to blame everything on immigration, that there are no immigrants. And suddenly we have this massive surge in the domestic-born population. Well, if you've been following the news in the United States, you may not like to tell everyone who comes to your door knocking from the Census Bureau that you came from somewhere else. So I think that this data might have been distorted. How did we suddenly, in a period of an aging population, get the fastest growth rate that we can observe in monthly data just a few months back in the domestic-born worker population? This, again, is suspect. But the point is that we should be looking at data and the issues that are going on in the United States. The discord that we have seen in the way things are being run is in effect. It is having effect, news effect on domestic consumer sentiment, and it's having a view of how international investors who send the U.S. a lot of capital are investing right now.
That's exactly right. So in putting all of what you've just heard together, the good news, I guess, is that we have going to have a very competent Fed chair. And the bad news is that the uncertainty indices and the uncertainties that have been built due to changes in foreign policy, much more aggressive nationalistic views, the changes that we've seen in the approach to immigrants in the United States, all of these things are now having a cumulative impact on markets and specifically on the dollar, on treasury purchases, and on people's confidence in the country in terms of our status as a extremely, quote, safe place to be. They are diversifying. That's the other mention I would say, is that foreign buyers, right, are looking around the world and diversifying. And one of the things we are doing in our portfolio is exactly the same thing, making sure that we are in the right place, diversified, but also taking advantage of the fact that these changes, right, which are likely to continue for some time, are we need to diversify and also to find profit opportunities, which we have. So
David, let's just say something else, because people do tend to get upset about political issues, and all of our clients have all sorts of different views. What we showed you on those policy uncertainty indices, we didn't make these up ourselves. And that data on U.S. Foreign holdings of U.S. treasuries, when I showed you that 10 years ago that this was falling, and Russia divested in 2018 under the Biden administration, these things happened again under different administrations, and we're showing you objective data here.
Yeah, and I don't think any comments, right, that we've made are they're factual. This is what's happening. This is the data. This is the behavior of people in markets. Now, the backdrop for all of this, if we were to go back to our documents in October that we reiterated at the very beginning of January, one of the things is that the backdrop of profitability, especially in the United States, but frankly now globally, is that corporate earnings are rising, right? This is not a time when there's a recession on the horizon whatsoever. And what's been fascinating about this time is that we had manufacturing that was really doing poorly last year. We talked about 1% growth in manufacturing, 4% growth in demand. We talked about the catch-up that we expected to occur. And Stephen will talk about the fact that that is actually happening. But we also talked about the fact there was this huge investment, right, in AI. And our concern, right, was more about chips than it was at that time about software. But the backdrop for all of this, right, is an extraordinary corporate earnings picture. And it is now a contrast between what's happening in software, where we've seen some pretty extraordinary numbers in terms of growth of revenues and profits, right? And therefore, there's the chance for markets to go up and for software certainly to recover, given our views on it. But the challenges to our favorite industries really are interesting, because when you have sentiment change, but earnings go up, Stephen, that is exactly what we're facing, both now in software and in healthcare. And those were supposed to be diversification for one another.
So I'll just give you an example. Last year, some of our industry choices, combined with other factors in portfolios across medium risk portfolios, led to outperformance by over 200 basis points. In January, that's down about 10 basis points below the benchmark. And when you see that little black line on the right, which shows you healthcare stalling in the month of January, and here we are in early February, not a particular concern when we expect that earnings will be recovering in the healthcare sector. And fourth quarters are not fourth quarters of last year are certainly not the whole picture. We go to the next page, there's a very interesting challenge. Now, if you think about what we have in terms of a software weight, there's a dedicated weight of about 2% overweight in software, but we take that weight out of the S&P 500 too, by having an underweight there. So when we're not taking a tremendous amount of equity risk, but it still hurts a bit when you take a look at that right picture. And there it shows software relative to overall tech. So you're dealing with an industry that has dramatically outperformed the S&P 500 over decades. And then the piece of it, software and services, you have to like, because any industry that makes a tangible good, that has an inventory that can depreciate or become obsolete, it's a lot different when you're providing a service. Your business can go up and down, to be fair. But again, you just don't have those manufacturing issues that create as much cyclicality and vulnerability in it. But there at the right, we have the situation where just in January, software is off nearly 20%. I'd love to have, again, our partner Abe Wano on this particular call to talk about Anthropic and Claude and these AI processes, which having the idea for a lot of people is that there's going to be obsolete software. You could make your own software or you won't need it because your AI functions are going to take care of things for you. That is true at some level, but let's remember what happened late January, February of last year. DeepSeek, the notion that we could train AI models to use a lot less computing power, so therefore we're not going to need NVIDIA chips anymore. Well, wrong. Making things better just creates demand for more. So demand for NVIDIA's chips has only gone up. Now, that doesn't mean you buy NVIDIA over a $5 trillion value. That's not what we're trying to say here. And we're not trying to say that some software doesn't become obsolete. But the basic idea that there's going to be better services. This is an industry that's constantly facing competitive challenges. And we think about software firms that are part of Apple's infrastructure in terms of apps. There's a lot of things that are going to come out of these firms that are going to be highly valuable. So that uptrend over the longer term on the right, we think very much that software, whether it's public or private, may be a question, but software, again, is going to be part of our future.
Right. And so when we think about how we build portfolios at CIO Group, right, our exposure to software, right, and our exposure to healthcare, these are things that are going to be larger and larger percentages of the U.S. economy, right, and are going to be, in our minds, profitable and benefiting from the actual efficiencies that are going to be generated by AI. And they are synergistic in that regard. There's an enormous benefit to healthcare in the use of software and in the use of AI in delivery of services and in the record keeping and analysis of data. So let's go to the next slide.
Just about cybersecurity is one element of this. Are you really going to say, well, I think I'll just trust my AI to keep me safe from cyber threats? Probably not.
Exactly correct. So we have been talking a lot about about diversification, and at the end of the day, when you listen to a program like this, if you don't take away anything, it's got to be that diversification matters, right? And U.S. assets relative to foreign assets underperformed in 25. As we said 2 weeks ago, we expect that that's going to continue this year. And the reasons I think we've laid out very clearly are that there are lots of doubts about U.S. policy and its impact, right, on confidence and on what foreign investors are doing here in the United States. We feel that that should have an impact on you, investors in the U.S., where seeking diversification makes absolute sense. You can see on the left the outperformance, right, in dollars of Brazil, of Mexico, of Japan, et cetera. We don't like all of these places this year as much. But when we think about what you should have in your portfolio, you should have exposure to the industries with the greatest profit growth, exposure to the countries that are going to do best, and the stocks within those countries that are going to give us good performance locally and the benefit if the dollar declines. And we should be thinking about diversification also in the bonds that we hold and the way that we're going to actually take advantage of the slightly higher rates that Stephen talked about that actually took place over the last week or so. This concept of diversification is both for safety and ultimately for the total return that we seek in portfolios. Everyone thinks that diversification comes at a cost, and it does, sometimes. But there are other times like this, when having a diversified portfolio actually has the benefit of delivering both. So, Stephen, when we take a look at the right chart here, right, and we talk about this outperformance that is 15 years in the making and last year's being a single anomaly, right? Why would we have confidence that you could have several years, right, when the non-US assets would do as well or better than US in dollar terms?
Well, it's really that history, that half century of history that shows really well-defined cycles in the dollar. And the Federal Reserve, we still think will probably be easing somewhat further. That doesn't matter if it's Kevin Warsh or Jerome Powell. It really depends on the way they focus on the cyclicality of the U.S. labor market. The U.S. labor market isn't protected like Japan's, for example. So American interest rates go up and down. Now, sure, we're closer to the end of that, but the dollar in inflation-adjusted terms is 12.5% now, above its long-term average. And it has these questions, again, about the willingness of the U.S. to provide what it has over the last half century, to be the world's reserve currency above all other things. The U.S. has other goals, right, besides just being the world's reserve currency. So when I look at this history, these really well-defined cycles, the higher valuation that we have in U.S. assets, again, it doesn't mean that non-U.S. stocks, let's say, the oil producers in Brazil are somehow going to have the same PE multiple as American software providers. It's not the case at all. But there's going to be probably some mean reversion here for multiple reasons, including the exchange rate. So if you look at the next page, and you think about our asset allocation, here we are within medium risk portfolios, things that you could think about as a global 60-40 roughly. We've got 21% of that whole allocation in non-US equities. Again, we talked about the gold earlier. David, you can remember the calls we get saying, how come you don't have more gold in the portfolio? And suddenly people say, well, why do you have any gold in the portfolio? This sort of thing. We have this minimal weighting right now. We believe it has diversification value in portfolios too. If we thought that real interest rates were going to go through the roof, it wouldn't be such a gold environment for gold. Maybe we wouldn't have any at all. But the fact that it went up like a meme coin or a meme stock, again, was a reason for us not to have a great big position in gold.
Great. Well, thank you for joining this week. It is remarkable how much news has taken place since January 1st already. It is a time when having deep analysis, turning that analysis into actual choices in portfolios, and then making those choices, which are not easy to make, that's our job. And a lot of people right now, when they look at their portfolios, should be concerned if they actually see that they're over-concentrated in just one thing, if they have no international exposure, if their bonds are really all in one asset class within, sub-asset class within bonds. This is a time when you can make great choices in portfolios. There'll be a time when that will not be as easy to do. And so as we think about next week, looking forward very much to seeing you back here, Stephen, on next Thursday, when we will be back again with another issue of The Point. Thanks for joining us.